Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a great day. Today I want to make this sort of a quick one. We're financial advisors here at Jazz Wealth. We manage customers' accounts and everything. And one of our customers sent me an email saying, hey, what do you think about this video that Mr. Dave Ramsey put out? Do you agree with it? And I never like to bash anybody. You notice I don't have videos that say people are bad or they're making bad decisions or anything. I just don't believe in that. Good karma, whatever. So one of the videos really caught my attention that he sent to me, where Dave Ramsey basically said, you know those 4 funds that I suggest that you invest in them your entire life. So you might know that the 4 funds he suggests are rather aggressive. They do quite well, and a lot of people give him grief because he says he averages 12% on those funds, and people say, well, that's not right. You can't do that. The market averages less than that. How do you, they claim he's a liar of some sort. I don't really buy that, right? He says they average 12%. The stock market, or the S&P, averages 9.8% over the long run. Its entire history, actually, just raw numbers with dividends and everything. And so really, he's just doing 2% better than that. That's fine. That could very well be possible with those 4 funds. It'd be an interesting study to look up all of the best performing funds and put them together and see if that's really the case. But I don't think that's a problem. Even if those funds did 1% better, but they collected an additional 1% in dividends, there's your 12% right there. So I'm not really arguing with that. What caught my attention is he said, whether you're 30 or like 80, 90, whatever, you should keep that same mix of funds. And I just think we can do a little bit better. I'll put the link to the video below so you can check it out yourself. And I'm in no way bashing Mr. Ramsey. I think if you watch me, then you know who he is. And man, anybody that can get to that level by providing good, honest advice and trying to motivate people to do right by their finances, how can you give someone like that a hard time? Here's what he said, and I want to try to improve on what he said here. So, like I said, having the same funds your entire life, taking that same level of risk, there's almost no financial advisor that's going to agree with that, but here's why, right? He's forgetting what's called sequence of return risk when you are taking money out of your retirement. So meaning when you hit retirement age and you start plucking out some dollar amount every month, every year, whatever it is, you got to be very careful here. We maybe don't want to take that much risk. And so, as I usually do, I'll give you an example here. Let's go and say that by the time you retire, you've got $1 million, right, in your IRA. You've done a great job. Maybe it's your entire nest egg. You got the 401k and everything, and you're invested in those 4 funds. At some point, you're going to want to back down that risk even just a little bit. Now, in the video, he argues that, well, you got to keep up with the cost of gas. You got to keep up with normal inflation and everything, and I agree. But do we have to swing so hard? So if you had $1 million in your account, you hit age 65, and let's say that's your magic age that you decide to retire. Worst case scenario, let's plan for the worst here and pretend the worst has happened. Let's say the stock market falls for the next 2 years. 20%. That's not unreasonable, right? That happened. That actually just happened in 3 months, going back October, November, December. So let's say that happens, and it will happen sometime during your retirement if you live to be like 87, something like that. So let's say the decline is 20%, and each year you're plucking out, you need income now, you're retired, so each year you pluck out $50,000. Well, let's say this is year number 1 and year number 2. So you've taken out $50,000 and an additional $50,000. Well, if at the point where the markets fall 20% and you've taken out the $50,000, your account value is now $700,000. Some of you won't care. Some of you will think, oh, that's pretty scary. I took some income out, but man, at this pace, I can't survive, right? I can't live if we keep going at this pace. Now, naturally, the markets will recover. They don't go down forever. They have rough patches. I get it. But let's say that happened. Now, what's going on here? You're plucking out the $50,000 each year. You lost 20%. You're down to $700,000. All right, no problem. That's a 20% decline minus the withdrawals that you also took out. If the markets recover that entire amount over the next year, let's say they just straight back up, well, in reality, you need now a 25% gain. I just did a class for this for our customers to kind of explain if the markets fell 5%, how much would you need it to bounce before you became whole again? If they fall 10%, you need 11% actually to recover. If they fall 20%, you actually need a 25% rally in the markets to recover. So I'm going to pretend in this example that over the next year, all of that decline was erased. Well, of course, over the next year, you would have taken out another $50,000, right? You got to have income. You're still living. So you've taken 50 out year 1, 50 out year 2, 50 out year 3, and the markets have recovered. They've came back all the way to where they were. Well, if that happened, you would have now a total of $825,000. That's not so bad. You're not feeling bad anymore, right? It's actually $875,000, but if we back out the additional $50,000, you're down to a net of $825,000, okay? So that's the example that he's giving, saying hold on for dear life, go for that ride, you can do it, you can survive, and you can, but you have a lot of mental issues during that time period, right? That's going to be pretty freaky to watch that happen. So let's do the same example, and let's just say that you participated in only half of what the markets did. That's reasonable. Right? If you participated in half the growth of the market in retirement, you'd still make up enough for inflation, you'd still make up enough for the cost of gas and all those things that he referenced in the video. Let's say that now, instead of that average of 12%, you're saying, okay, I'm going to average 6% by using the Dave Ramsey funds, if that's in fact the case. Like I said, I can't verify that, but if that's what's really happening, let's take the same scenario. Markets fall for 2 years, you take out 50K, you take out 50K in year 2, but now the markets fell 20% and you only fell 10%, right? Because you're participating at half the pace. So I drew that sort of wrong. Let's say it went like this, right? You only fell a total of 10%. You got 20 down here and 10% right here, okay? So at that point, you go, okay, not so bad. Now to recover, I actually only need an 11% gain to become whole again. But as I did in the previous example, I said the markets recovered all of the declines all in 1 year. So they recovered the 25%, which means you recovered enough to get back to whole again, right? Same thing. Still with me? All right. Well, if this happened, in this case, now your account value, assuming your withdrawals as well, would be $943,500, right? One more. Nope, that was enough. Sorry, I put one too many zeros on there. But you get the point, right? Now, 3 years later, you took out $150,000. You got all the way back to where you started. You got $943,000. All because you chose to invest a little less aggressively. Now, I'm all for being aggressive, right? I have no fear of the markets in the long term. I'm like, Warren Buffett, same thing. He just invests. He just buys more when the markets fall. You can't argue with that, right? But here's the thing. Some of you watching this will say, I can handle that volatility. The market's falling and I have 700,000, then I get back up there. I can handle that. Some of you will say, I can't handle that. That's crazy. That's an obscene amount to risk in that time period. What happens if we fell 30%? Or worse, we had a 50% decline and I'm plucking out $50,000 all along the way. What if it took 4 years where the markets declined and then went sideways? So now you've got a depressed account value that you're plucking out. You're selling those shares cheaper and cheaper so you can have that income. And because of that, most financial advisors are going to say, hey, when you get to retirement, let's take a little less risk. Let's go hunt for dividends, slower moving things. Let's see what bonds are paying. Let's see if we can go ahead and get you a great return without participating one for one, or even worse, like Mr. Ramsey there, if what goes up 12% has to fall at least that much as well. Maybe you can't handle that volatility. So I want you to keep that in mind. Again, I'm not bashing Dave Ramsey. Great advice. The fact that he's trying to motivate people to stay in and stay aggressive, I agree with it. But I think that sequence of return risk in retirement is something we should really focus on, and maybe a way to improve on the overall dollar amount that you get to keep in your pocket, meaning your account will last a lot longer. Hey, anyways, I hope this is helpful for you. Like I said, I'll put the link to the video below in the description if you want to check out what he said. Very short video, very fine, nothing wrong with it. We'll be back later, 5 o'clock today, to do our stock market update, where we're going to actually cover what happened in the market, the good, the bad, and the ugly. If it was ugly, we'll talk about it and sort of follow up on things like this. And then later tonight, actually, at 8 o'clock, the class that we normally do for our customers. Every week we do a class for customers where it's more detailed, different topics and things. Well, this one we're going to do publicly on YouTube here. If you go to our YouTube channel and you want to watch that as well. It'll be at 8 o'clock Eastern Time. I hope you'll join us for that. We're going to talk about active trading and sort of success stats and failure stats and things, and try to dive into that a little bit if that fits what you're doing. Hey, I hope you'll check us out. Enjoy the rest of your day. Thank you so much for watching. Hit the thumbs up button if you will, if I helped you in some way. If you're Dave Ramsey and you disagree, I guess you'll hit the thumbs down button, but no harm, man. I mean no harm. So enjoy the rest of your day. We'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.